Let's try it again. There. Can you see the screen?
Yes.
All right. Yay, I did it. All right. Welcome to the M&M Team Realty's Home Buyer Seminar. Thank you for taking time out of your busy schedule to join us. Just in case you didn't know, my name is Theresa Miller, and I am the broker and owner of the M&M Team Realty. And we have an amazing team, 14 awesome, super fantastic, well-experienced realtors who are here to help you. And our motto is helping people make dreams come true. Don't they all just look lovely? I'm so proud of them. I want to share a few statistics with you before we get started. In case you didn't know, this is a seller's market. Because it's a seller's market does not mean that you cannot purchase a home. What it does mean is that you need to connect with us as your realtors so that you are well educated, that you are well informed and prepared to attack the home buying process. For example, the median home price has increased over 16% just since last year. You would say, well, you know, there's a pandemic, there's a lot of stuff going on. What's happening? Well, people, in Theresa's opinion, are sitting at home. They've been in their home for the past 2 years. They've looked around. They've decided that they're working from home. The kids are having school at home. They're doing all these things at home, and they need more space. So they are out there looking, they're searching, they're finding what they want, and they are purchasing homes. Homes that are too big, the sellers are relocating. A lot of people are relocating out of state. So that's great. But guess what? It's still not enough inventory. And as a result of that, the median home prices have increased, like I said, up to $740,000. Take a look at this chart. If you can see that on the left side is 2005, all the way up to 2020, 2021. The red line represents single family homes. The blue line represents the townhouses and the condos. And as you can see, the prices are steady going up. I have talked to a lot of people who have asked me, well, Theresa, is there going to be a bubble? Is the market going to fall? Is it going to crash like it did in 2007, 8, and 9? The answer is no. In 2007, 8, and 9, it was a financial crisis, a financial foo-fa, for lack of a better term. That's not the case now. Today, the problem is there's not enough inventory. There's no more land, especially if you want to live close in within the city. There's no more land. So there's no more space to build these homes. Currently, right now, we are seeing multiple offers on homes that are strategically priced, let's say in the $500,000, $600,000, or even $700,000. I was talking to someone just yesterday at one of my meetings, and they told me that they received over 150 offers. What do you do with that? How do you stand out? Well, we're going to talk about that today. We're going to show you how to stand out in this market. Someone else said they received 30 offers. I was calling to make an appointment for one of my buyers. This property had just came on the market literally that morning. I was on my way to church. By the time I left my house, drove to church, text the person, wanted to make the appointment. They said, we just sold it. I said, how is that possible? You just listed it. The neighbor bought it. You know, it's the craziest thing. The market is crazy. The reason why you're here is you're going to learn how to participate in this crazy market. What I want to do now is I want to get the ball rolling with the very first person who's going to share the home buying process. So let me introduce to you Ms. Mary King Batiste. Take it away, Mary.
Thank you, Theresa. Good morning, everyone. I'm here to talk to you about several things, but first wanted to let you know that my background has been over 30 years in the healthcare industry. I've been on the health plan side, a little on the sales side, and now I'm in information technology. I love what I do, but real estate is where I plan to end my professional career. Probably it'll be my lifestyle from now on. So with that said, I wanted to say that I am a mother of 4 and a grandmother to about 13, and I have 3 great grands. So I'm very proud of my family, their accomplishments. And this is something that we talked about when my children were very young. I didn't know that I was going to be the one to start it off, but here I am. So let's go to 7 reasons to work with the realtor. Number 1 reason is that we're not just agents, but we're professional members of the National Association of Realtors. And we do subscribe to a strict code of ethics. So all of us, our ethics is based on professionalism and protection of the public. So you can trust that you have expertise, you have honesty, and you will receive ethical treatment from each and every realtor, especially in M&M Team Realty. As an expert guide, you will receive, in purchasing your home, tax benefits. IRS allows you to deduct your interest that you pay on your mortgage, your property taxes, and some of the cost involved in purchasing your home. Also, there's appreciation. When you buy a car and you drive it off the lot, you pay, let's say, $10,000 and you drive it off the lot, it's worth $8,000. So it depreciates immediately in value. But with the home, it actually appreciates, meaning that you'll receive maybe an average of 5 to 5.2% each year. So it'll increase in value. Also, you build equity in your home. So money that you spend on rent, that's money that you'll never see again. But your mortgage payments is what allows you also to build that equity over time. And you can look at it as a savings. It's a savings account. It's money that you may not see in your bank account, but over the years, it will build your savings. So let's say if you decide to sell or even refinance to draw money for a project or something, you can generally take up to $250,000 as a single person, or as a couple, $500,000 from your home. And you won't even have to worry about where the savings is coming from. It's there. Predictability. When you purchase your home and you decide on 15, 20, or 30-year fixed rate, your payment stays the same until your mortgage is paid off. So that is something that you don't have to worry about when you look at rent versus purchasing. Rent may increase, but your mortgage payment will stay the same. You have the freedom in home ownership to do what you want to do in your home. You can spruce it up any kind of way that you change the paint color, put pictures on the wall, and the way you would decorate your home. It's all yours, and you have that freedom. And you also have stability. When you purchase a home in the neighborhood that you desire, you will build long-lasting relationships. Your children will attend the same schools year after year, and they would also find a sense of stability and community. Now we'll talk about 7 reasons to work with a realtor. I started off telling you that you will receive ethical treatment and expert guidance from your realtor. And we want to make sure that we hear you, that we know what you want, and then we will make it our business to find you much of what you want. There's no perfect house per se, but once you see it, it would be perfect for you. So we just make sure that we're guiding you in the right direction. It will require lots of forms, and we've been trained. We have that expertise to assist you in completing those forms, and we have the knowledge and the expertise to help you prepare for the best deal and to avoid delays or any mistakes. We offer objective information and opinions. We can provide you information about the utilities, the zoning, schools, and more. We also have objective information about the property. Realtors normally use data to help you determine, or help us even in assisting you, determine if the property has what you need. We have expanded search power. Sometimes we are able to find properties that may not be properly advertised, and it may be just that home that you desire. So we have that expanded search knowledge or power to find the perfect home for you. We have the ability to negotiate on your best deal for you. And we just ask that you trust us to be able to do the best that we can do for you. We have up-to-date experience. So even if you've purchased a home before, every year the laws changes. So we have to learn what those laws are and make sure that we represent you well, and making sure, again, that you're getting the best out of your home purchase. And finally, we will be your rock during emotional moments. Sometimes purchasing a home, it's a big deal. It really is. It's probably the biggest purchase of your life. And so we're here to be your wall. We're here to be that shoulder to lean on. And we want you to just know that we're concerned about you, and that we'll just be here for you in your home purchase every step of the way. Now, how are agents paid? As you can see from this screenshot, that sellers pay the commission. And the commission is split 50% to the listing office and 50% to the buying office. And that 50% is broken up, as you can see on the left, 15% to the listing broker and 35% to the listing agent. On the buying side, it's 15% to the buyer's broker and 35% to the buying agent. The buyer typically pays no commission. And at the very bottom, the percentages in the chart are generalized and intended as an example. Real estate commissions vary broker to broker, agent to agent, community by community, and state to state. With that said, I'm going to present to you Linda Henry to share some more information on the home purchase journey.
Good morning, everyone. My name is Linda. I have been a realtor for at least the last 15 years. And one of the reasons I love being a realtor is because I love helping people. And I would like to let you know that it's especially exciting to go out and look and find new homes. So let me go ahead and walk you through this buying process. So the first thing you should do when you're choosing a realtor, you should ask questions. And some of the questions that you should have is you need to know how long they've been selling real estate. And sometimes, even though they've been selling real estate for a long time, does not mean they have the skills to be a realtor. So a lot of times when you when you're looking for that realtor, it's a lot of it is on the job training. So the next question you should also ask is if they have any designations or certifications. Now, all that means is that you need to know if they have additional education behind their name. Okay, then one of the other questions that I would ask you would be, how would you like to be communicated with? me personally, I like to call you on the telephone because I would pick it up and give you a call. But I know in today's society, because of new technology, some people are so busy, they would like to have a text or an email or be sent an Instagram message or even on Facebook. So you need to let me know exactly how you would like to be communicated with. And the last question that you need to ask is, can you have some references? Who have you worked with in the past? And the reason for you asking these references is just to know if you get a reference and you call them and you said, would you work with this person again? And then they said, no, I would never work with them. But that wouldn't be a person you would choose. So you would make sure that you ask the references if this person is somebody that you can trust. So the next page, we talk about the vocabulary and the agency relationship. We have the buyer agent. The buyer agents work with the buyer, just as it says, and then we have a dual agency. So then we have the selling agent, which is also the listing agent, and the selling agent is also known as the listing agent. And the listing agent, he makes sure that everything is done. So then we go on to what they call the client versus the customer. So with a client is they are the one who has the relationship with the agent. They have a legally binding contract, and and that agent must make sure that that person's interest is above all other. So we have to make sure that if anything go down, that you are the one that comes up first, the most important, that we go out and do our fiduciary duty. So as with a customer is just someone who's out looking to buy real estate, and they have not signed up with an agent, and this agent, it has the responsibility to be honest and ethical. So now we have what they call the buyer broker agreement. What is it? It's a legal document and formalize where your working relationship with a particular buyer's agent. Why should I sign it? The buyer rep agreement clarifies expectation. It helps you to understand what you should or should not expect from your buyer. So I'm going to send you a buyer representative agreement. And this serves two purposes. The first purpose is that we can get your full legal name spelled correctly and to confirm your email. The second is to make sure that you can receive the confirmation of documents and can sign them electronically. And once you sign the documents and send them back, now we're ready to go out and look for your home. Mm-hmm. Now we're going to prepare for the hunt. Okay. Know that there's no right time to buy a home. Don't ask for too many opinions, because when you get ready to buy a home, everybody got something that they want to tell you. Everybody know what you need to do. Everybody know how you need to do it. Okay. And so accept that no home is perfect. Don't be a killer negotiator. Don't think that you have to give the lowest low ball offer, because you have to remember, everybody's out there, they want their home. They want the same home that you're bidding for. So you make sure you put in a good offer. Make sure that you listen to your realtor. And if they give you suggestions, make sure you consider it. And just remember that your home does not exist in a vacuum. Okay, now you need to prepare ahead. So you need to find your home, make sure you love it, make sure you choose to talk to your mortgage broker and be ready for the move. Make sure you are, make sure your maintenance and repairs are considered in your budget. And just know we have already sent you a budget in your packet or email that you received from us. Okay, now what about your credit score? Maintain your credit by paying your bills on time. Don't pay your bills late. Do not overextend your credit. And just make sure everything you do is above board. Do not go out and purchase anything during this time. Just make sure that when you're preparing to buy your home, that you do exactly what your realtor asks you to do, and your pre-approval mortgage person. Now, next we're going to have Miss Sasha. Take it away, Miss Sasha.
Thank you, Linda.
You're welcome.
Hello, everyone. My name is Sasha. I am fairly new with the M&M Team Realty, and I am excited to be here. Okay, I am going to dive right in. Okay, so we are going to talk about the neighborhood. So when you live, where you live should reflect your lifestyle. And we're going to go over some questions that you should consider when looking for a home or when purchasing. So some questions that you want to ask are, is it close to your favorite spots? Is it safe? Is it economically stable? Is it a good investment? Do you like what you see? And what's the school district like? So these are important questions that you're going to want to go over with your realtor, or questions that you may want to, ask yourself before considering purchasing a home. Now, let's say you're considering a condo or a townhome. Okay, so condominiums, townhomes, and properties located within a homeowners association offer certain perks. And it's important to consider the items that I'm going to go over with you in your decision process. So some questions that you are going to want to, ask yourself or just look for in this process are, how much storage is available? How's the outdoor space? Are amenities important to you? That's a big one for people. Who handles the maintenance and security? Are there required reserve funds and association fees? How much are they? What are the average vacancy rate? How many units are owned by investors? And can I meet with other residents before making an offer? So again, like I said, homeowners are condos, townhomes. Sometimes they may have a condo board. So again, some things that we've already reiterated are, how many units are owner occupied? And these are questions that you can ask the condo board so that you can learn how responsive and organized the members are, how fast they get back to you there. So, be on the lookout for that. So let's say you've submitted an offer on your condo or your single family residence. Now it's inspection time, and it's time for you to choose a home inspector. Okay. So the cost for a home inspection is approximately between like $350 and $500, and this is paid upfront by the buyer. Okay, so you want to ask some questions, some key questions to this home inspector. Do you belong to a professional association? Will you report all state requirements? How experienced are you? How do you keep your experience up to date? Do you focus on residential inspections? Do you offer repairs for home improvements? How long would the inspection take? And then can I be present for the inspection as well? So as your realtor, if you're not able to be there, I can be there for you. We can do a phone call, we can do Zoom, whatever you want to do, and I can tell you play by play. Okay. Okay. Next, about the home inspection. So some things that you want to just be on the lookout for are, of course, the roof, plumbing, electrical, heating, HVAC, fireplace, ventilation, things like that, the driveway. Those are some things that you want to keep an eye out for. Okay. Okay. Next, we have appraisals and taxes. Okay, so this is something that Joe will, he'll go over in depth a little more for us when it comes to the appraisal and property taxes. But So for property taxes, after escrow closes, you may receive what is called a supplemental tax bill. We're not sure of this amount. This amount is unknown, but you will be on the lookout for it. And you may receive it after escrow closes. But again, like I said, Joe Soto will touch more on this. I will pass it along to Theresa.
Good morning. Okay, I've been on real estate or a realtor for a little over, well, almost 8 years. I've been with M&M Team Realty going on 3 years. I'm in my 3rd year. And before that, or even during that time, I've been in finance for about 30 years as bookkeeper, accountant. I've even possessed insurance license and been a notary for over 13 years and also a loan signing agent. So everything is still somewhat related to the whole process. I got into real estate. I love people for one, and it's exciting seeing and even being a part of people in their home buying process. You know, as Mary mentioned, you know, the ethics and all that involved. So we can guarantee that we're a good team player and that we can help a person acquire their dreams. So it's wonderful being a part of that process. Okay, going forward, how to write an offer that appeals to sellers. And as Theresa had mentioned earlier, this is a seller's market, so we have to be competitive. That's what we have to keep in mind. She mentioned also that there was a home that had over 150 offers. So the offer that stands out is the offer that wins. So we have to remember, you know, we want to appeal to the seller. So going next, the purchase agreement. And that's a contract between individual or entity that's selling the property and the individual or entity that's purchasing a property. So that's a pretty, how would I say it? Very critical agreement. And so in that purchase agreement, first off, they ask you not to submit offer letters or photos because that's considered an implied bias. Used to be a time that you can offer a photo of your family, your pets, whatever, and, you know, appeal to the seller's emotions, but that's no longer allowed. So they ask you not to do that. Then the earnest money deposit. They are asking now pretty much, or like I said, staying competitive, that you offer at least $10,000 and more if possible. Even suggested up to 3%, but you can always offer more. More is better because you want to show the seller that you're really interested. Contingency periods, shorter the better, you know, because the seller, when they list a home, they're anxious to get it sold. So the quicker the better. In contingency periods, you have the length of escrow, which is 21 days or less. These are desired. The appraisal, 7 days or less, or 7 days. The home inspection, about 7 days. And the loan within 10 days. And then, and during this period, it gives time for the investigations to take place, to make sure, you know, everything is in order. And it also, you know, if not, it allows the to cancel the escrow. Okay, and then the home warranty. This covers the repairs and replacements once you've acquired the home. And this typically the seller, it's seller versus buyer who pays, but typically it's been the seller. But again, to be competitive and appealing, you know, it wouldn't hurt to offer to pay it, for the buyer to pay it. You know, that, of course, the seller would like that because it's less money that they would have to pay. And then termite, yes or no. Sometimes the termite report is necessary. If it's a VA loan, it's required and it cannot be paid by the buyer, even if the buyer wants to. That's termite report. You know, and it's good to know, as Sasha brought out, having the home inspections and all, you want to know what's going on with the house. So these things are important. And also, just to say, the home warranty, like I said, it covers repairs, replacements, and for home systems also. So even air conditioning systems and things like that. So it's important. Okay, the escrow company. Escrow instructions are sent to the buyer after escrow receives the earnest money deposit. When you put the deposit down, that means you're really ready and you're serious. The title insurance provides proof of clear title on the property. It lets you know that the seller is who they say they are and the buyer is who they say they are, and that the seller has a right to sell the property. There's times that, things are going on nowadays, a lot of scams. And it also protects the buyer. Linda had an example, if she would share, of a situation that happened here. Linda, would you care to share that a little bit while we're on that? You're muted.
Oh, say it again, Theresa, I'm sorry.
You had given an example about a situation where the seller or buyer wasn't who they said they were.
No, that wasn't it.
That wasn't it?
No.
Okay.
I'm sorry.
It was something on that one. Let me know. But okay, let's move on. I'm sorry. It'll come up later. The seller's disclosures. I'm sorry. We're going to the next one. Okay, the seller disclosures, they're given to the buyer during the first week of opening escrow. And this will disclose everything that the seller knows about the property. Examples are transfer disclosures, HOA documents, and others. And one that stood out to me was, say if a person dies in a home within 3 years, that has to be disclosed. Someone can't die in a home and you don't tell. It has to be prior to 3 years for you not to disclose that. And, sometimes that's very important to buyers. They want to know, some people are superstitious or spiritual or whatever, and, they want to know these things. So disclosure, that's a big key word during this process. Things need to be disclosed. Okay, going forward. Homeowners insurance. You want to make sure you have enough insurance to cover everything, including the contents of your home as well as the property. Buyers can bundle with their car insurance to get the bundle rate. We see the commercials with Flo, and that's something that she can't keep to herself. That's always funny to me. But, like I said, it's not just a matter of your home, but your property. The homeowners can, their assets, their valuables within the homes, this insurance can cover that. Loan docs. Buyers will receive the clear to close from the lender. So once escrow and title has done their part and everything is clear and right, they will, let the buyer know we are clear to close. We can close now. So the buyers will meet with the notary to sign the loan docs. And me being a signing agent, you may get a call from me. And that's exciting also as well, especially for new home buyers. Buyers will wire final funds to close escrow. So if there's a shortage from what you've paid initially, it'll be found during this process and they'll let you know, that you have final funds to pay or not. And funding will usually occur the day after signing. We had a situation on one where they closed, or they cleared before the deadline. And, it was offered, we can close a few days early, but the owner, she was an elderly woman, she elected not to. So we had to stick with the final date. So with Joe, it's been proven that sometimes we close sooner than the initial date thought. So again, that's exciting. Funding will usually occur, okay, I said usually the day after signing. So then you'll do the final walkthrough. When you first saw the home, before you made an offer or anything, apparently it appealed to you and you chose that one. So then you go back and do a final walkthrough. And after the inspections have been done and maybe there's repairs that was suggested or required, you get to walk through and find out, did these things take place? And also that the home is at least as good as you found it, Sometimes, either required or even sometimes it's not required. We had a situation too where the owner's daughter came through and found a leak. When we came to do the walkthrough, there was a hole in the wall, but they elected to pay it. And their agent, the seller's agent, she really went off, her and her broker, because they was like, you shouldn't have done that. But it was to an advantage of the buyer because they paid a couple $1,000s in repairs for a leak. So the walkthrough is very important. Confirmation of deed recording. The deed is recorded in your name at the county recorders after all these things have taken place. Now it's party time. Time to receive your keys. It's official. You're now a homeowner. So at this time, we'll come with our cameras. I would like to say our camera crew, but we'll come with our cameras and videos and our soul sign because we want to take pictures. It's a great celebration for you as well as for us. And, like I said, it's great to see the joy on the buyers' faces, when they go through this process. We come with gifts, smiles, a lot of time the buyer has families and others there to experience this. It was said earlier, this may most times your largest purchase. So it's a great endeavor. And then we'll ask you for video testimonies, and it's sort of time for you to rate your realtor as well. But, it lets us know and it gives us a warm feeling to know we did a good job. We helped you acquire this dream. And as well, we'll publish that, look what was done. So, and then you get to share your experience. And now I'm going to welcome Rita to share with you the next part. Thank you.
Thank you, Dee. Hello, everyone. My name is Rita Noah. I am a new realtor with the M&M team. My background, I worked for Spectrum Cable, formerly Time Warner Cable. I worked with them for about 10 years. And the reason I chose real estate is because I feel like a matchmaker. I want to help you find the home that puts that big smile on your face. So that's a little bit about myself. I do have 4 boys and 1 granddaughter. So I'm a grandma, thank you. But yes, let's get into it. Let's prepare for the move. All right, preparing for the move. So one of the first things you want to do is you want to change your address. You can do that online at USPS.com or at your local post office. Update your address with the doctor's offices, your banks, credit cards, utility company, and especially the Wi-Fi, because we all need our Wi-Fi. So we definitely need to do that as well, get that transferred over. If you're moving out of state, definitely you want to get in contact with the doctor's offices, get any records for you, yourself, anyone in the family, get all your records, take those with you. So, that's something you really want to make sure it's on your to-do list. All right. And on the to-do list, creating the master to-do list, some of the things I said earlier, change your address, make sure you update your address with all their service providers, get all the vital records that you need. As well as if you're moving out of town, some people, don't really think about this, but if you're moving out of town, you always want to send a family member your route. If you're taking the scenic route, doesn't matter. Always send someone your route so they know where you are or where you should be. Things happen, your car breaks down. Yes, we all have cell phones, but we don't have service everywhere. As well as when packing. Okay, so when you're packing, you definitely want to discard a lot of old items. I know that a lot of us, including myself, when I was moving, I'd find things that I was like, oh, I was looking for that 5 years ago. Okay, I haven't used it in 5 years. I don't need it. Let's get rid of it. Let's take only the things that we need and that we're going to use. And plus, we're getting a new home. Let's go shopping. Thinking about shopping, moving into your new home, you want to change your locks. Not just your front and back door locks. You want to change your sliding door locks. Any doors in the house, you always want to change all your locks, as well as your garage door opener. We want to change that as well. And, if the house does come with a security system, definitely check out your security system. Wash, clean the board, make sure everything is set back up to you. If not, definitely might want to think about getting a new security system. Pets. I don't have any pets, but if you do have pets, definitely let's make sure you get all your pet records from pet records. If you're going on a long trip, you have a little kennel for them. Let's not leave our pets in the car. That's not a good thing, right? And pretty much, like I said earlier, for new owners, change your locks. And at this time, going through everything, good luck buying a home. And we are going to introduce the amazing Joe Soto.
Can you all hear me?
Yes.
All right. So I'm going to do a couple of things. If everybody looks on the bottom of their screen, I think I'm going to take over control, right, Teresa? Yeah. Okay, at the bottom of your screen, you got the little reactions button. So if you want to ask a question, you could raise your hand. You can give me a thumbs up. You can let me know you're there, paying attention, all of that fun stuff. Because we're going to talk about loans, and loans can be boring. Everybody loves scrolling and looking at houses, but loans itself is not the most riveting thing in the world. And so doing this on Zoom is a little bit difficult. So I will urge you, if you want to ask a question, you can just, again, raise your hand and then I'll unmute you, or Theresa will unmute you, or type in the chat, because I'm going to go through some stuff and it could be confusing. It could be a foreign language. You could just have more questions about stuff. So I highly, highly, highly recommend, if you have a question, just ask as we go through things. Fair enough? I'll look for some yeses. Perfect, that'll work. Told you it's hard when you're just talking to a screen. This is not easy, people. So let's see if my screen share works. Make sure I have my correct window open. That one.
You can do it, Mr. Soto.
Really good at loans, bad at technology. Good at loans, bad at technology. We're working on it. We're working on it. Let me move everybody's pretty little faces over here. Can you all see my screen?
Yes.
Thumbs up. All righty. Let me know if I'm yelling or if I'm too loud, because I tend to project like I'm in a big room talking to a lot of people, and instead it's just me talking to myself in the camera. So I'm Joe Soto. I always joke, husband, father, all around good guy who also does loans. I try not to be Joe the lender, even though I'm mostly just Joe the lender. So that's why I say those other things as well. Been in the mortgage business since 2004. I got some of my contact information up there on the screen. We do have a 24-hour bat phone. I actually need to change that because I'm getting to the age where people don't know what the bat phone is. I'm that many years old. So for those of you who get that bat phone reference, thank you. For those of you who don't, I'm just old. Follow me on social, Instagram at your favorite loan guy, on Facebook, YouTube, even on the TikTok. I'm all over it. If you don't know how to follow, you can just scan the QR code and you can be able to follow me on there, all the little icons and all that fun stuff. And so I normally like to start with the story. And I tell this story a lot of times when I'm doing this class for first-time home buyers. I get a call one day. I'm originally from New York, originally from Brooklyn. And I get a call from my friend Eddie's wife, Naomi. God bless Naomi. She is a spitfire. She is your typical angry New Yorker. She calls me. She comes in hot. Joey, this is Naomi. Eddie told me to call you, and he wants me to talk to you because I got to get out of my parents' basement, right? This is, I think it was 2019, 15, one of those years. I don't actually remember. We got to get out of my parents' basement. I really think Eddie's going to hurt my dad. And there are so many damn mice that it's just, he just doesn't want to live here anymore. My dad won't clean it up and it's horrible. So he told me to call you because he wants to see if I could buy a house, but this is a waste of time because you know where we're from and people like us just don't buy homes. And I'm originally from Brooklyn and I grew up in a really poor neighborhood, and she's right. A lot of our friends don't buy homes, but not all of them. right? And so I took that as a challenge. I was like, oh, really? People like us don't buy homes. And it still resonates with me. It still gives me chills when I tell the story. And we wound up going through her pre-approval and going through some numbers. And Eddie had some money saved in a 401k through work. And so that conversation, I believe it was on September 9th. I don't remember the year. It was either 15 or 17, but I know it was September 9th because my birthday is on the 19th. So I'm 100% sure of the date. And so we had that conversation on the 9th. And December 14th or 17th, I call Naomi up and I go, hey, Naomi, it's Joey Soto. What are you doing? Where are you at? She goes, we're on our way to the attorney's office, Joey. And I go, really? Why are you going to the attorney's office? Did Eddie get in trouble? And she says, no, we're going to close on the house. And I said to her, true story, and I stopped the screen share on purpose. I said, Naomi, do you remember what you told me when we first talked? And she goes, rolled her eyes. No, Joe, I don't remember. I go, you told me people like us don't buy homes. And where are you going? And she goes, we're going to buy a home. And I go, all right, so you can't say that ever again, right? Sure enough, Naomi and Eddie now own 3 homes, 2 rentals, and a primary residence. So it can be done by them, could be done by somebody you know, a friend, a family member, a coworker. It can be done by you. And I think that's one of the greatest stories I'll ever tell. Still gives me chills because he's the best friend I've had since 12 years old. So there's my preaching. Hopefully, while I was preaching, you scanned my QR code because that was like my delay tactic. No, I'm just kidding. So we're going through agenda, what we're going to talk about. We're going to talk about ICE. And ICE is how you qualify for a mortgage. That stands for income, credit, and equity. We're going to talk about different loan types, programs, and assistance. We're going to tell you the difference about pre-approved versus pre-qualified. And then at the end of this, hopefully you're empowered. You're able to do a little survey for us. We'll get you on the path to buying a home. That sound fair? I'm trying to look at faces that I see. Cool. So I think Theresa talked a little bit about the market and how crazy it is. And one of the things I like to show people is why it's so crazy. So here is the why it's so crazy. This was not on my slide. I just added it in. Go. Okay. We're going to talk a little bit about renting versus, Joe. Needs to let me click. I'm sorry, everybody. Doesn't let me click. I have to start over. So we're going to talk about renting versus owning real quick. And we're going to talk about generational wealth, right? I told you that I grew up in Brooklyn. My mom still lives in a co-op apartment studio, 1 bedroom, probably like 760 square feet. She does not want to leave Brooklyn. She has no desire to come to California and be with her only son. But hey, to each their own. So this here is showing you the difference between paying rent and buying a property at, let's say, $600,000, right? I'm a numbers guy. So for me, this is riveting stuff. For other people, you may tune out and only hear like wah, 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 wah. But I love it. So when you're looking at comparing a house to rent, there's a difference of about $1,000 in payment, right? 27 to about 38. Tend to pad this a little bit to give us a cushion. But that gives you an idea. And Theresa, I'm not looking at participants. So if there's a question, you have to let me know. You don't see that? Dang it, Joe. See? Good thing I looked, huh? Share screen. Let's try again. Share screen 2. How about now? Do you see all my numbers? All right. So if I flash back, let me know if you don't see it. So the difference between rent and owning, right? At, let's say, a $600,000 purchase price. I just picked the number from this guy. The difference in payment you can see is about $1,000, right? However, when you own a home, there's a tax benefit because you're going to get the tax deduction on the rent, on the interest, and the property taxes that you're going to pay. You're also going to be paying principal, right? When you rent a house, you're basically paying the landlord's mortgage. When you own a house, you're gaining equity. And this $867 a month is coming back to you. If you were to sell the house, this is like your own savings, right? This is you investing in yourself. So when you're looking at a net monthly payment, and I hope you guys can all see it, and you're comparing your $2,750 in rent versus your $2,300 net payment, you can see that the net monthly payment is lower than your potential rent. So a lot of people look at it and say, oh my gosh, I'm going up in payment. But in reality, you're actually spending less by owning, right? That's why we've seen the market get crazy, because people have realized that. The other thing that we're seeing is down here when you look at rent versus principal paid. So this is like the make you sick number. If you've been renting for the last 5 years at 25, 27, $3,000, over 5 years, you would spend, factoring in rent increases, about $178,000 in rent. You would pay down your house about $57,000, right? So that's a $228,000 swing. Big difference. Here's where it gets even better, everybody. Your net worth. So you own a house for 5 years, it appreciates 4% a year. At the end of renting, you have how much? Teresa, how much is that? I'll put you on the spot. She's muted, but she says 0. That's her answer. Versus if you own a home and you've paid down the mortgage and it's increased in value, you would have $230,000 that you could sell that house and take that money anywhere you want. This is why there's so many people out there trying to buy.
I'll take those odds.
Yeah, they realize that that's the win, right? So people are taking from their 401k, pulling $20, $30, $40, $50,000 from their 401k and turning that 30 grand into 200 grand, right? If I told you you could take 30 grand to Vegas and come back with 200, you take that deal 10 times out of 10. So again, this is just a 5-year look back, right? I could change this to be a 10-year, 20-year, 30-year, but this is called generational wealth, right? This is what hopefully you can pass on to your children and your grandchildren, and really just change people's lives. And I didn't learn this, everybody. I didn't learn this until I met my wife, because all of her family always owned homes, and I rented my whole life. And she taught me about that sort of stuff. So it's something that we want to not only learn ourselves, but also teach our children and our grandchildren and everybody around us. So that's a little bit of that. Anybody have any questions on that? I'm looking at my chat. And I always like to ask if anybody has questions, because listening to me talk can get really boring, or especially if you've heard me before, right? Like Taylor's heard me before, and she's like, all right, Joe, enough is enough of you. I'm pregnant. I just need to get this over with. I got to pee. Sorry, Taylor. I just saw your face. All right. I don't see any questions. I'm going to roll.
That was a really good scenario. It really puts it in perspective as what Mary was talking about in the beginning. So now you showed us the graphics. I mean, that's a no-brainer.
Yeah, for sure. And I think people a lot of times think of the short-sighted, right? Like the pain of the monthly payment versus the wealth that you're going to get long-term. I mean, that's it, right? Like that's the big game changer. And I didn't learn that for a long time.
Mm-hmm. The average rent now is at least $3,000 to $3,500. So it's crazy.
Rents are ridiculous.
Mm-hmm. You spot on, Joe.
Ridiculous. So share my screen. I'm going to come back to screen share. Hopefully I don't mess this up. Okay, you should be back on my presentation, right?
Yes.
Cool. All right, let's talk about income, credit, and equity or down payment. So how the lender sees your income. A lender looks at your W-2s, right? So you either work for a company or you're self-employed. So if you work for a company, you get a W-2. Typically, we want to see that you've been in the same line of work for 2 years. Maybe you've switched companies and that's okay. but you can, at least you're being employed for 2 years. Lots of different quirks with COVID if you miss some time for COVID, but we can go into that. If you have any bonus or commission income, that does require a 2-year history. So I talked to a client recently that's making about $8,000 a month in medical sales, in commission. Great income. Unfortunately, he's only been making it for like 11 months. So out of that 8,000, he could use a big whopping 0 because he doesn't have a consistency of making that income. Overtime as well. Overtime requires a 2-year history, and then it gets averaged out. So you have to be careful on overtime as well. And then cash is never good. So I get this question a lot, right? I work in XYZ industry. My boss pays me half cash, half on W-2, or all my income comes on cash. Cash cannot be counted unless it's reported on the tax returns for 2 years. So I had a client recently who owned a salon, all cash business, but they claim a lot of that income on their tax returns. What's claimed on the tax returns can be used as income, but you can't just say, I have a lot of cash and, let me just use the cash. Can't do that. We don't like the money laundering. And I see Armida has a question. Armida, can you unmute yourself? Or can somebody else?
Hello.
Yep, there you go.
So my question is, my husband is the main provider. I do work. It's been a very limited one, but I haven't worked in more than 2 years, more than 20 hours a week because I was in school. So would that affect the loan process, or would the loan most likely just have to be under his name and not mine at all?
It's probably better to do it in just his name.
Okay.
Just because if your income doesn't count, guess what still does count? Your debt.
Oh, okay. Okay.
Right. So if we can do it with just him and see where you're at, then you can try to run it with just him. And then eventually if you're done with school and your income gets added, then at that point you move up, right? Like that's what me and my wife did, is we bought into something at first where it was just my income. And then she literally finished school and started making money. And then all of a sudden now we have a joint income. We could qualify, go from a condo to a house. So that's what I would do.
Okay. Okay. Thank you.
Cool. D asked about bonuses. Good question, D. So if you do get a bonus from your job, you have to have a 2-year history of getting a bonus. So let's say you work for Theresa and Theresa's just shelling out bonuses and you got a $5,000 bonus in 2021, but 0 in 2020. Can't use it. Doesn't count unless you have gotten a bonus for 2 years consecutively.
Good, John.
Good question.
Mago has a question.
Mago.
He says, I have a question for one of my clients, taxes from out of state, earned income from rentals.
Taxes from out of state are okay, but it doesn't matter where you're at, as long as you're paying taxes and filing taxes. Earned income from rentals, that is on a tax form called the Schedule E. And so that can get a little bit tricky because depends on what you show as income. So what some people do when they have a rental is either A, they don't claim all the rental income, right? They're getting $3,000 a month, but they tell Uncle Sam they're getting $1,000 a month. That's not good because only what's reported on the taxes is what's going to count. And if you're taking too many write-offs and you show negative income, that could actually hurt you. So it's that fine line between showing income and breaking even versus, saying, oh, I'm going to write everything off so I don't make any money. You can't do that and still get a house.
Juanita has a question.
The best thing to do is to just say the truth.
Say that. Yeah, that's easier said than done, man. A lot of people don't want to do that.
Or not.
Huh?
Whether you're gonna pay or you're gonna not pay taxes.
Yeah, I mean, I think for a lot of people, they you have to pay in order to get pre-approved. Mm-hmm. But then maybe you get to a point where you start limiting, then you can lower it once you get to a certain point. But initially when you're in it, like you're just paying, right? But
Just
again, looking at that wealth accumulation, right? If in 5 years you're going to make 200 grand in equity and it costs you 5 grand in taxes in 1 year, what's the better
pennies
deal?
to the pennies to the dollar.
Yes, pennies to the dollar. Good analogy. I like that one.
Yes. Juanita has a question. She says, does your income have to be the same for 2 years? What if you were at the same job but recently got a promotion or a raise?
So promotion or a raise. So you don't answer both questions. You don't, and I'm looking over here because I see the question. You don't have to be at the same job for 2 years. So let's just say you worked for Apple and then you got a job working for Sony and you left because you got better money. That is okay as long as Sony doesn't pay you in only commissions and only bonus and only, overtime, right? If it's salary to salary, you're fine. Only time it gets complicated, Juanita, is if it's overtime bonus commission.
Sasha has a question. What about disability income?
That's a really good one too. So disability income, a complicated question. The answer is it depends, because if the disability is permanent, right? Like, so if the client, if the person got diagnosed and is getting permanent disability for the rest of their life, that's easy. Boom, you can just use that income, right? So 3 grand a month, that's usable as long as it's permanent disability. Where it gets complicated is temporary disability. And so the 2 ways that you can do that is either A, you'd have to try to qualify on the temporary disability, but you have to know when the client's going back to work. I thought we had that situation one time, Theresa. Didn't we have somebody who had to go back to work?
Yes, we did.
I thought we did. So if they have to show proof that they're going back to work if it's temporary disability, like let's just say maternity leave, right? You're on maternity leave, you had a baby, you're still out. You can qualify using your actual real income as long as you're going back to work within a certain time of closing. So complicated answer in that one, Sasha, but that's a great question.
Mm-hmm. Claudia says, is it possible for a retired person to qualify for a home loan?
As long as they have income, right? So if you have a pension, if you have Social Security, if you have disability, if you have rental property, yeah, you can qualify. There's nothing against, you don't have to have a job per se, as long as you have income coming in, right? Like I have some people who are retired and they're just pulling money from an annuity and they go and buy another property. So there's ways you can work around it as long as you have income coming in. What we look at is your ability to repay. Mm-hmm. Ability to repay. Good questions.
Yeah, they jamming.
See that? Who said we couldn't be interactive on a Zoom? I love you all. Thank you. Good questions. Self-employed, it gets a little bit more tricky, right? Because again, it's not what you make, it's what you keep. Did my calculator open up? Nope. Where is it? It's gone. Okay, no calculator. So let's say you run a business. I just have a guy who I'm working with right now who has a bunch of followers on YouTube. This is a true story. And his income is really, really high. Writes off a ton. Let's say for argument's sake, what's left is $100,000. He could take $1 million, write off 900,000 and leave 100,000. Well, the 100,000 would be his qualifying income. So got to be careful on what you write off if you're self-employed. You typically have to have a 2-year history of being self-employed in order to qualify. There's some instances where you can use 1 year of taxes, but in order to qualify on 1 year of taxes, you must have been self-employed for 5 years. You can't just open a business this year and say, here are my taxes. But if you've been self-employed for 5 years, we may be able to qualify you on just 1 year of taxes. So that could help, because then, like we said with Mago about being honest, right? Then you only have to be honest for 1 year instead of being honest for 2 years. So there you go. Cool. Good, good, good. Any other questions on income?
LaRonda says, do you qualify clients on the gross or the net income?
It would be net income. And for some reason, let me see. There we
you
go. Can you see that?
Yes.
So let's say you have a gross income, LaRonda, of 300 grand, right? You do TikToks and you're making 300 grand on TikToks. That's actually real people do that. But you write off all your expenses because TikTok's expensive to maintain your life. And you write off 250 of that. 50 grand is your net. That's what we're going to qualify you on. Not what you make, what you keep. Yes, Juanita, I think we are recording, and I believe Theresa will send it out.
Yes.
Cool.
I will send it out.
All right. But what happens if you've been in school? The school count, right? So we have a lot of clients who are in nursing school, x-ray tech, learning a trade, whatever it is. Education can count as experience. So I get this a lot with doctors who been in medical school, did a residency, were making 50 grand a year. Now they get out and they're making 300 grand a year. You can use that, again, income, as long as it's salary, and we can connect the dots, right? You went to Long Beach State, you graduated, you got a degree, now you're an engineer, and now you're making big bucks. So you can use that, and you don't necessarily have to have a history of 2 years of employment. You can go right from education into work. So I think it was it Armida who had the question about, like, she was in school. You can go from school, get a job as an x-ray tech or whatever, and just use that income. So that would help.
Mm-hmm. Sasha asked, what about amended taxes?
Ooh. You can amend your taxes. It's a free country. You don't like to amend them. Here's you don't like to amend them after you just talked to Joe and Joe told you the taxes were bad. That usually looks bad. You'd have to wait a little bit if you amended them, Sasha. So you can amend them. I have clients all the time, amended returns. Here was the issue, and now you show more income. You can do that. Where you'd run into issues if I ran your credit today, the lender can see that on the 19th. You go and amend them on the 21st, and then you try to buy a house on March 1st. That might be a problem, right? Because it looks like you only did that because Joe told you.
Right. Armida says, just to clarify, I can try to be on the loan, but my school loans may be an issue, correct?
Correct. Yes, because all of your debt counts in the equation.
Mm-hmm.
Student loans, car payments, credit cards, right? I always joke it's California is 50-50, so it's still going to count. Good questions. So next we're going to talk about credit. Credit is one of my favorite things to talk about because regardless of anything in life, your credit affects you everywhere, right? Credit cards, car loans, student loans, everywhere. So just a high level thing. I'm actually doing a seminar on credit at the end of the month, which I'll give you guys the information on if you wanted to go more deeper into it. But a couple of different things that affect your credit, right? First, credit is graded on a scale from 300 to 850. So one of the challenges that I have in my life and in my business is this thing. Can you all see what that thing is? It's a cell phone. The reason that the cell phone is a challenge for me is because Credit Karma and Experian and My Fico and all of these websites that say they give you their credit score don't give you an actual FICO score. If you read the little fine print, it's usually a Beacon or a Vantage score. So this is the FICO score scale. If you're looking at your credit score and your credit score says, oh, the max is 925, you're not looking at a FICO, right? You're looking at a different type of scale. So here's some of the things that go into your credit, right? Payment history affects your credit the most. Your debt utilization. So the rule is to keep your balances below 50% of your limit. So if you owe $5,000 on your Best Buy card, You want to keep that balance below 50% of that, $2,500 at all times. That will have it be reporting as good credit. Credit history, length of credit history counts for 15%, right? That's why typically our parents and grandparents have better scores than we do in most cases, because they've had credit for longer, right? They have longer accounts. They have high balance, high credit limits. So that helps your credit. New credit. So I think, having more than just student loans or more than just a car or more than just one thing helps, right? So types of credit and then the new credit kind of go hand in hand, because I find that people who don't have a lot of credit have to open up credit and get new credit. It's like both at the same time. So having new credit helps. Over time, initially, you may see the score drop a little bit, right? You buy a new car, score drops a little bit. You open up a new credit card, score might drop a point or two. But over time, that's going to help you build the credit, and then diversifying that credit too. So having different types of credit.
Mary says, can they defer, or they can defer school loans, right?
Yes, you can, Mary. I hate deferred student loans personally, because back when the market crashed, lenders weren't hitting people for student loans, right? It'd be like, oh, you're not paying, counts as zero. And then what happened was people had to start paying on their student loans, and then they defaulted on their mortgages. That was one little aspect that many people don't talk about. So even if you have student loans, we're still going to count a payment against you. Even though through COVID, right, student loans were deferred forever, it seemed like through the whole 20 and 21. As a lender, we still have to count a payment against you with student loans. So it still counts as a debt in your ability to repay.
Mago says, using the ICE method, doing a pre-qualification for a loan, and one of the person's credit is low, but their income could be part of the pre-qualification areas, asking for a client.
Great question, Mago. So banks are not fair. Lenders are not fair. So if Theresa and I are getting a loan together, and let's say I have 800 credit score, but Theresa has 600 credit score. Sorry, Theresa. Right. Teresa's 600 credit score is going to bring me down, Mago. So the qualifying score is the lower of the two credit scores. So they can both be on there, like on the pre-qualification, but the lower score is going to factor it. Where a lot of people think, if I have an 800 and they have a 600, well, the average is 7. That's not how it works. It's the lowest score is the determining score. So you might have a little bit of a higher rate. You might have, I just talked to a client literally like 3 days ago. She had a lower score. Her dad had a higher score. And so the rate was higher, but without her, the dad qualified for like 400,000. With her, they qualified for 700,000. Right? So, it's going to affect the qualification, but I think having the two incomes is better than having one. That help, Mago?
Awesome. Thank you.
Cool. Sasha, good question. What credit score is considered good? I think if you're somewhere in the above 700 is really good. I say 720 is kind of a good number as far as when rates get affected. When you get into the 600, it's, can affect rates and pricing and stuff like that. Oops. So anything 720 and above is really good. If you're in the 750, 770, 780, 800s, that's like amazing. When I first met my wife, I was like down here in the very poor. She still kept me around. So we got here. I finally have passed her up like in the last 2 years, but it took me 16 years of marriage to get there. So anything is possible between me and Eddie, the Eddie story, anything is possible. Cool.
Are you looking at the AGI on the taxes?
Yes. So we're looking at trick question, Sasha. We look at AGI. I said yes, and then I changed my answer. You saw what I did right there? Trick question. So when you're W-2'd, right? This is where mortgage business and qualifying is a little bit skewed, because when you're W-2'd, and let's say you make $80,000 a year, right? 80,000 a year divided by 12 means you make 66. Oh, that's an ugly number. Sorry. That's let's say you make $7,000 a year. Too many sixes in there for me, people. Sorry, I'm Catholic. You make $7,000 a month gross, but that's not what you keep, right? You're gonna pay Uncle Sam, you're gonna take your insurance, you're gonna put your 401k. What you keep may be, $5,500, $6,000. But when you're W-2'd, we qualify you on the gross number. When you're self-employed, we use the adjusted, we use the lower number. So if you're W-2'd, and I have clients who work for big companies and they're making, let's say $250 a year, right? And they're dividing that by 12. They're making $20,000 a month. They're not keeping $20,000 a month. We're qualifying them on 20, but they're not keeping 20. So when you work for a company, gross. When you work for yourself, net. Good. Cool. So a couple of little tips on credit. Because credit is a big part of the equation, right? And you want to be in a best spot to purchase a home. So paying down the balance is the first thing that you can do. Making sure you keep them below 50% of the credit limit. If you can get them below 30% of the credit limit, that's even better. But you always want to keep that balance below 50. Even if you pay it off monthly, right? Like, hey, I run my Amex up and I pay it off every month. What's reporting to the bureaus is that higher balance. If you look on your statements, the higher balance is what's reporting. So try to keep the balances below 50% all the time.
Joe,
Yes.
I have clients that always tell me, I want to pay down my credit cards before I talk to Joe. I'm going to go pay this, and that. Should they do that before they talk to you? What should they do?
It depends. So if you paid off all your credit cards today, right? And you wrote them all, you paid ACH, you do auto pay through the bank today. It may not hit the bureaus until March 10th, 15th, something like that. So there's a little bit of a delay in that. I think a lot of times we can look at it and run the scenarios and say, if you paid off your debt, here's what your score would do. Other times after we run the credit, we can say, hey, pay off this debt instead of this debt.
Right.
Sometimes people don't know, right? So you'll go and pay Uncle Visa when you really should have paid off Amex, right? Or people pay installment accounts, and you shouldn't pay installment accounts before you pay a revolving account, right? Pay the credit cards before you pay off the mattress or the Peloton bike or whatever. I see more Pelotons, Theresa. More Pelotons on credit. I'm like, oh, what'd you buy? A bike? I did. How'd you know that?
Affirm.
I look at credit all day long. I see that Affirm everywhere. So
that's why I always tell them to talk to you first, because you can let them know what they should and should not pay and how it's going to affect them.
Because the last thing you want to do is dump $5,000 into something and it didn't do anything. You paid the wrong debt, right? So paying new collections and letters of getting a letter of deletion. So I think there's different schools of thought on this, right? Where people will say, well, if I have a collection, I should just let it sit there. It's going to go away in 7 years. Sometimes yes, and sometimes no, right? Sometimes if I've got a collection with Mago Collections, I owe him $1,000. And I haven't paid Mago Collections because I think Mago Collections is going to go away. What could happen is Mago can get to year 6 and say, hey, I'm going to sell this debt to Glennis Collections. And now my 7 years would start over all over again. And now I owe Glennis Collections $1,000. So got to be careful on that. That's why I wrote in here, pay new collections. Anything that's reporting, you want to pay. Anything that's medical, you can get a letter of deletion, which if you don't listen to anything else I've said, letter of deletion should be the one thing that sticks with every single one of you, because a letter of deletion will change your credit for the rest of your life. If you talk to a creditor and you pay them what you owe them, you need to ask them if they will delete the item from your credit report. Because if they remove the item from your credit report, it's like it was never there. I've had client scores go up 75, 80, 100 points with just a letter of deletion. So that's the Joe Soto tip of the day, letter of deletion. Sorry, I made you wait an hour and 28 minutes to give you that. I apologize.
What about back child support?
Owing the back child support or receiving the back child support?
Owing. Let's start with owing and then do
owing.
receiving.
So if
receiving
you
should be good.
Huh?
Receiving should be good.
Owing back child support, it would depend. It depends on how it shows up on the credit report, and if there's a lien filed against you. So if you have a lien filed against you, then you have to pay that lien before you can do anything. If you just owe and you're making payments on the back child support, then just the debt, right? I'm paying $500 on the back child support. That debt counts against your qualification. On receiving child support, the kicker on receiving child support is that you have to have shown that you've received it for at least 12 months. So if you tell Joe, I get $500 a month in child support, but you can't show me a year's worth of $500 a month, then you get zero. Can't show me 8, or you can't show me sometimes it's 200 and then it's 300 and then it's 100 and then sometimes it's 7. Got to be 500 every single month. Otherwise it's a 0. Another question I got was about pre-approving. When should you see if you pre-qualify for a house or do a hard credit check? Timeline's $1 million question. I think it's always good to know where you're at in order to know where you're going, right? So that you can come up with a plan. So if your lease is up in a year and you just have no idea where you're at, like the story I told you with Eddie and Naomi, they had no clue, right? And they were literally 3 months later in a home. But I think it's good to just come up with a game plan and say, all right, here's what I want to know where I'm at. So maybe I have to work on my credit, or maybe I have to save, or maybe I need to get a cosigner. At least you know what that is. If your lease is up, let's say in December, you don't want to wait to December to start that. You probably want to start that at least 90 days ahead of time. That's what I would do.
That's good.
Building good credit. So again, good credit is low balances, high credit limits. So again, if you have a Visa, American Express, Discover card, any of those, and you've had them for a long time, you can call them and ask them if they'll increase your credit limit, right? So if they increase the limit, high limit, low balance is good. That's a good formula. That Discover card will probably raise your limit. You know why they'll raise your limit? Because they want you to spend it and they want you to be in more debt. But so asking will help you grow your score. Improving the credit mix we talked about, and then becoming an authorized user. Becoming an authorized user is really an easy way to get your credit score up, right? We talked about history and time, but let's say my uncle Ben, or no, let's say Ben's my dad. Ben, you're gonna be my dad, even though I'm old. I ain't gonna be your dad. I ain't gonna say I'm your dad because that would make me really old then. But let's say I don't have a good credit history. I don't have a lot of credit. I can go to my parents' family member and get added to their card as an authorized user, right? And so now what that does is Ben added me to his American Express. That American Express he's had for a long time, has a high credit limit and has a low balance. Now that line of credit is going to report on my credit. And what that does is that helps with credit history because he's had the card a long time, helps with debt utilization, helps with payment history, right? And all I did was piggyback on Ben. And I used him and became an authorized user. Now, don't do that if the person had late payments on the card. Don't do that if there's a high balance on it, because then that debt does affect you. And don't do that if you're worried about them paying it on time, because if I was added to Ben's card and then Ben decides he goes crazy and doesn't want to pay that card anymore, those late payments would count against me. So be careful, but it's a great way. I've had client scores go up 30, 40, 50 points by getting added onto parents' accounts. So that's a good way to do it. Juanita, great question. So is it okay to not use your cards? Kind of a trick question. So you cannot use them, keep the balances at zero, but there's times where the cards will cancel you if you don't use them. And a canceled card, so I just had this happen to me with Best Buy. I literally, hold on, if you can see me, I bought some pods. Can you see my pods?
Yes.
Yes, I bought some pods because Best Buy sent me an email saying they were going to cancel my card because I hadn't used it. And I was like, oh, no, you can't cancel me. I've had that card since 2008, right? If they cancel me, I lose out on all those years, that credit history, that balance, that all of that. So I took my butt into Best Buy and I bought some pods and I kept the credit line open. So you don't want lines to close. What I typically do, and I got away with it with Best Buy, is I have probably like 7 credit cards. I normally will use them in November, buy Christmas gifts, pay them off in December, and I put them back in the same sock drawer I have in the house. My wife thinks I'm weird, whatever. I don't carry them with me. I don't take them anywhere, but I use those cards. You'll usually see me, I'll go to Kohl's and buy something, and Best Buy and Apple Store, just to keep those cards active. So you want them to stay active. You don't want them to close. No, don't close any cards. Second most important thing Joe says, don't close any cards. Sorry, Rita.
Carlos says
exactly.
every once
Carlos,
in a while he buys undergarments and socks.
T-shirts and socks. Hey man, when I was growing up, Carlos, that was like every birthday gift was T-shirts and socks. I thought it was because my mom like really wanted to like get me T-shirts and socks. It was just because that was the only time she wanted to buy me those. Pretty funny. Sasha, we'll get into the lowest credit score. Usually 580 is the lowest. I just had a client qualify at 586, but it's very rare that you can get an approval that low. But you can go down to 580 technically. Usually in order to do that, you have to have other compensating factors, income, reserves, that sort of stuff. But yeah, 580 is the lowest. Cool. Any other?
Yeah,
credit
Sasha says, is it better
question?
if all cards are zero balance?
I say yes. Some people will tell you to keep a little balance. I think those are people who just like that. I say pay it off.
I agree. Zero balance.
Zero is better than paying interest to somebody else. So I personally only use 2 credit cards. I use one for business, one for personal. I pay them all off monthly, and that's kind of how I separate my life. Reserves are additional assets. So let's say, good question, is reserves are additional money that you have after closing. So let's say you need $50,000 for down payment and closing costs. After the $50,000, you would have to have any money that's left over would be reserves. So let's say if your mortgage payment, let's say after the 50, you're left with $10,000, $20,000, $30,000. That additional money that would cover your mortgage is considered reserves. So that helps make your loan stronger, right? If you're putting your down payment and closing costs, and let's say your mortgage payment's $4,000 a month, and you have 20 grand left over, right? Now that's what, 5 months of mortgage payments. So the more additional money you have left over would be your reserves.
Armida said, should she use the cards and pay it before she gets the monthly bill, or use the cards today and pay it in 3 days?
So I used to do it. I'm crazy, man. So this is like a great question. Armida, you and I are like spirit animals. We could be friends. I would pay it before it's due, before it's going the statement end date. So for example, if I have $500 on my ARCO card, and I know the statement ends on the 25th, I would go in there and pay it on the 24th so that it reports zero. That's my own way because I'm kind of a crazy man. But you don't have to, as long as you're keeping that balance below 50% of the limit, right? So if that limit on that ARCO card is $500 and you're spending $500, I'd pay it before the statement end date. If the balance is $2,500 and you're using $500, you're okay, just pay it as normal.
That's a
Good
good point, because I always try to pay it at zero, and then I get mad when I see it on the report. This is zero. Why is it there? Now I know the secret.
Yeah, they're always, so when your statement ends, they report the statement ending balance, right? Like that's what gets sent to the bureaus. So I think that's a lot of mistakes people make, is they're spending 1,000 and the limit's 1,000, right? And so that's what they're, then it reports that they 100% credit utilization versus they pay it off every month. So just keep the balances always below 50%. That's the key. Yes, and Mary's correct. You can't write off more. You can't write off credit card interest. That just goes to them. So next we're going to talk about down payment. I'll just give you a little bit on down payment. We talked a little bit about wealth, right? And equity and stuff like that. So you can use your savings, checking, 401ks. You can get a gift from a family member. You can get money from anywhere, really. It gets a little quirky when it comes from overseas, but typically we don't want to see cash, right? Cash is usually bad, usually has to get put into the bank. You can't just say, I've got all this money sitting in my safe at home, let me use it to buy a house. We've got to figure out a way to get that into the bank so that you can use it for your down payment and your closing costs, right?
What's the earliest time they should get in the bank?
It depends on the type of loan you're doing it, but 60 days in advance at least would be the best if you can get it in there that soon. Otherwise, you'd have to do it as a gift. So again, I've had a lot of clients over the last couple of years, using their 401k and pulling money out. And, again, when you look at the ROI, your return on investment, and if you're pulling, if you pulled, I don't know, 25 grand, right, from a house. And the thing that makes real estate really attractive is you take that 25 grand and you buy that $500,000 house, let's just say. That house is going to increase, let's say 5% a year. That house is going to increase 25 grand a year. So you took out 25, you made 25. That's 100% return on investment, right? You took out 25, you made 25. There's no financial planner on the planet of the earth, anywhere, don't matter what country, where you're at. If you got Bitcoin, if you got Dogecoin, well, maybe Dogecoin if you bought it at the right time, that's going to get you 100% return, right? I saw Ben laugh. See, he got my joke. So it's a great ROI, right? Taking the money from these places, especially if you're not near retirement age, you still got a long way to work where you can kind of replenish that savings. And then we're going to talk a little bit about down payment assistance programs. I'll kind of go into some options on that. LaRonda, good question as far as where the gift funds come from. That's another, it depends. So on a conventional loan, you typically don't have to show where the gift funds come from. On an FHA or VA loan, you do have to show where the gift funds come from. So if Mary was giving me a gift, let's just say Mary's going to give me $10,000. Thank you, Mary. Mary's going to give me 10 grand. On a conventional loan, Mary just sends that money to escrow. Nobody's going to ask where it came from. On an FHA or a VA loan, Mary's going to send the 10 grand, but then I also need Mary's bank statement to show me she had it. So if Mary deposited 10 grand in cash, thumbs down, that's not good. So FHA and VA, we're going to ask for the gifter's bank statement. Good question. Calculating your debt to income ratio, we're going to go into payments a little bit over there with different options. So I'm just going to run through that because I know I'm going through coming close on time and I want to be aware of everybody's time. So what are closing costs and who pays for them? So closing costs are broken up into two categories. And so I always like to talk about cash to close because you have your down payment, you have your closing costs, and you have your prepaids. So when you buy a house, right, you're not only putting your down, which I should have put a category in there for that. I apologize. You have your lender, you have your closing costs, which are usually about 1 rule of thumb for your closing costs and prepaids are going to be 1.5 to 2% of your sales price. But a lot of times when you think about closing costs, it's lender fees, it's appraisal, it's title, it's escrow, it's recording. So closing costs are all your third-party services, which are lender, title, and escrow. That's your closing costs. Where things get expensive is on prepaids. And prepaids are what are collected for property taxes and homeowners insurance. So if you were closing today, you would have to prepay future taxes and future insurance. So sometimes when I talk to clients, their closing costs might be $6,000. The prepaids might be another $4,000. And they're like, whoa, why are my closing costs $10,000? It's two different buckets, right? They'll tell, well, my friend bought a house. He said his closing costs were like $5,000. You're showing me $7,000, $12,000, $10,000. Because also what's included in there is prepaids for taxes and prepaids for homeowners insurance. So keep in mind that that's all included in what we like to call cash to close. Cash to close would be down payment, closing costs, prepaids, all three in one, right? That's the total amount of money that you're going to need. Any questions on closing costs or prepaids?
Mago says, does it make a difference if you buy in February or in November as far as paying the property tax?
Mago, this isn't your first rodeo. I like it. It does matter, Mago, because taxes are due in April and December in California. So if the property taxes are due, typically the lender is going to collect more at closing if taxes are coming due. So if you were to buy, I always say the best month to buy if you want the lowest prepaids is May. May gives you the largest window before you have to pay more taxes because you don't pay it till December. That gives you May, that gives you June, July, August, September, October, November, December. It gives you 7 months before you have to start paying taxes.
Sasha has a question about cash deposits.
Yes, fire away, Sasha.
How should it be deposited?
It depends. Since this is recorded, we may have to sidebar on that. I don't want to get myself in trouble. I'm just kidding, Sasha. So don't do the Marty Bird method. If you know Marty Bird, you should laugh at that joke. If not, that was a bad joke. You want to get the money in the bank. Typically, smaller increments are better, right? And it just depends on how you're going to get it. So again, if it's coming from if it's going into your account and it's not normal to have those deposits, you're just going to have to get it in small deposits and then wait. If you're getting it doing like a gift, that person's going to have to do small deposits and wait. I don't know what gets flagged by IRS. I don't know what that number is. Is it 5,000 or 4,000? But that's basically what you would do is get it into the bank in small increments. And best thing with cash is to try to do it as a gift if you can. If you can't, then you're just going to have to wait. Right? You have to put it into your bank account now in February and basically wait 2 to 3 months before you can buy, because in 2 or 3 months, those cash deposits aren't going to show on your statement. Right? So that's the kind of trick. And what we look at as a lender, we look at, oh, here's the February statement. What are these deposits, right? All of her other deposits are payroll, and then ATM deposit. We're like, ooh, that's not normal, right? Cashier's check. Thank you, Rita. Rita got my joke. Thank you, Rita. Cashier's check. We would have to see who it came from. So there's a cash. So Michelle gives you a cashier's check, Sasha, and you deposit it into your bank account. We probably want to see Michelle's bank statement to show that she had the cash to get the money in the account to give it to you. Meaning if Michelle went and deposited 10 grand in cash and then did a cashier's check the next day, no deal, no bueno. Does that make sense?
Claudia says, what is the money amount of a cash gift that would raise eyebrows?
We would never use a cash gift, Claudia. I don't know that answer because I don't know like what the IRS would look at. But let's just say Claudia was giving me $100,000 to put down on my house.
Mhm.
And she sends that $100,000 from Claudia's account to escrow. I wouldn't know, right? Escrow, nobody's going to know that that cash was deposited into Claudia's account except for the bank and the IRS.
Mhm.
So for us, we wouldn't know it's cash unless you showed us a bank statement. But if we did see a cash deposit on the bank statement, we wouldn't let you use it
Okay.
as down payment,
Mhm.
even though it's real money. I would still take the 100 grand, but the underwriter would not let us use it.
Sasha asked about wire transfer.
Same thing, Sasha, as far as a wire transfer. So if you get a transfer from Michelle, we're going to want to see that she had the money in her account. The best thing to do is to have the gifting person send the money directly to escrow. Never send it into your bank account.
Mhm.
Best way to do it. So it would be Michelle sending it to Joe Soto Escrow Company or something like that. I gotta switch my screen so I can pick new names as my tests in here. Cool. Good stuff.
Mhm. Is there a season period on funds?
2 to 3 months. And I say 2 to 3 months because that's a it depends question. Depends on when your statement closes, right? So I couldn't say February and March, because if your statement ends on February 16th, then we'd have to wait till March 16th statement and April 16th statement. So it's anywhere from 60 to 90 days, as long as we don't see any large deposits on 2 months of statements.
Okay.
Good question. I got all new people on my screen now, so you're all in trouble. Tracy and Mary, y'all my guinea pigs right now. Mortgage payment. So I like to reduce things to the ridiculous. If you've ever heard of Tom Hopkins, he's an old sales guy. And so he likes to reduce things to smaller numbers. And so I like to do this just to try to show people like small amounts of payments, right? So if you're financing $100,000, your payment would basically break down like this. You'd have $477 of mortgage payment. You'd have $104 of property taxes. You'd have about $14 a month in homeowners insurance and $70 a month in mortgage insurance. So that's assuming you're putting 3.5% down, right? Minimum down payment. So you would have private mortgage insurance or PMI. And that basically shows you everything that goes into a mortgage payment. So I just had a client in escrow, just got into escrow. I sent them payment breakdowns, right? You all saw my fancy mortgage coach. I show him everything, right? And he still says to me, like, as soon as escrow opens, he goes, well, Zillow says, right? And so the first rule is when a sentence starts with Zillow says, it's like when your kids are lying to you. You know they're about to tell you something false. He says, Zillow says the taxes on this $1.1 million house should be like $6,000 a year. Why are you telling me they're $13,000 a year, Joe? I said, because I deal with facts and accurate information, right? And so he literally goes on to show me on Zillow and Redfin how they both had the taxes estimated at half of what they normally were. And so he was just like he said, why would they not have the right number? And because they're using the old owner's tax rate versus the new owner's tax rate. So this is a general rule of thumb. For every 100K you finance, you're looking at about $665 per month in monthly payment. I am such a simpleton that I try to break it down for different payment amounts and different numbers. So every 100K, you're looking at $665, 200, 1330, right? So as you're going up in financed amount, the payments get higher, assuming 0 down, right? Assuming 3.5% down. And so again, general rule of thumb, not final numbers, but just to kind of give you an idea, if you're like, hey, I want to keep my payment around $3,000 a month. You're somewhere about $500,000 purchase price. Did Theresa get kicked out?
No, I'm here. That was
Oh, there's another Theresa.
my other device.
Oh, okay. I was like, Theresa got kicked out. We're leaving her out. I was gonna make you sweat it. I was gonna make you text me and be like, "Let me in, Joe."
See, you ain't right.
Oh, it's so funny. Sorry, I had to laugh. So again, I like this little chart because I think it helps. It helps to show you based on how much house and how much payment you can afford. And it's a general rule of thumb, right? Obviously, if you're putting 20, 30% down, those payments go way down because you're not going to have PMI or anything like that. But again, just general numbers so you can kind of get an idea. For every 100K you finance, here's what a payment would look like, including taxes, insurance, mortgage insurance, principal and interest, the whole 9 yards, not just mortgage payment, right? Because I get this sometimes where people say, "Hey, I saw this $800,000 house. It says it's like $3,000 a month." I'm like, that's not the rest of the payment, right? So you got to factor. I'm a big budgeter. I think it's important to know all of those numbers in order to budget. PMI, PMI is mortgage insurance. It's called private mortgage insurance. And so anytime you don't put 20% down on a property, you're going to pay private mortgage insurance. And that's an insurance that only protects the bank. Doesn't protect Tracy or Mary or Juanita or LaRonda. See what I did there? New names. Doesn't protect any of them. Protects Bank of Joe. And what happens is you start with that private mortgage insurance because you're not putting 20% down. But as that value increases, right, which Theresa talked about at the beginning, and value is going up, you have the ability to get rid of that PMI. So PMI, private, let's say it's 70 for every 100,000. On a $500,000 house, that PMI is probably about $350 a month. And once you have the equity, you can get rid of that $350 a month. So your payment would now come down to about $3,000, somewhere about there. There you go. If you're unsure how much you want to buy or may qualify for, what do you recommend to save? So we're going to talk a little bit about that, Armida. I'll get into down payments. Look at that. Next screen over. Down payments. And so you can buy with as little as 3.5 or 5% down, depending on the type of loan. So again, the savings amount, right? It depends on the property. 600,000, and you'll see that I did an example there times 3.5%. That puts you at about $21,000. So again, there's programs to help you a little bit with down payment, but anywhere from 3 to 5% of the purchase price that you want to be at, right? So if you're like, hey, I want to be at $4,000 a month, you know, that's $6,000, 600,000, right? Like then you could work the savings off of that.
But that doesn't include closing costs though, right, Joe? So really you kind of need a little bit more.
Does not include closing costs because closing costs are another 1.5 to 2% of the purchase price. Right? So you would have 21,000 plus the closing costs of, let's say, 2%, puts you at 33 total. Which I think I have a slide on that. It should be coming. LaRonda, I did that at 3.875. I believe I ran it at 3.875. I may have even padded it at 4, just because the market's been trending higher. So I tend to put it right about there. It's always better to plan for the worst and hope for the best. Because then you're not surprised with the higher payment later. That's not good. So just give you a high level, different types of loans. FHA loans are mostly for first-time home buyers. They're basically regulated by the Federal Housing Administration, and that is typically 3.5% down. You can go to a 580 FICO score. Has to be your primary residence, and typically they have more flexible guidelines. So FHA guarantees the loan, and they make the guidelines a little bit more loose for people buying a home. All right, higher, easier to qualify. Let's say it that way. Conventional loans are based on risk. So you could put anywhere from 3 to 5% down, depending on the purchase price. You can see they have a higher minimum FICO. You have to have a 620 versus a 580. And they're risk-based loans. So in that example I gave earlier, right, I think the dad had a 790 credit score and the daughter had like a 630 credit score. I mean, it was a huge difference. The rate was based on that 630 credit score. I think, let's say it was like 4.25 or something like that, because they were putting a minimum down, versus he would have qualified for a little bit lower rate had it been him. I think it was even higher than 4.25 if I remember correctly. So conventional loans based on risk, FHA loans are not. FHA loans are more flexible on most guidelines except for condos and townhomes. So if you're looking at a condo and townhome, FHA is more restrictive than conventional. Conventional has more options if you're looking at condo or townhome. Next is VA loans. Literally the biggest no-brainer in the history of mankind. If you or someone you love or someone you know is eligible for a VA loan, they should be using it. It is cheaper than renting 100 times out of 100. Zero down payment. You have to have military service. I think it's 90 days of active duty or 6 years in the reserves, if I'm not mistaken. Has to be your primary residence as well. But the VA loan is a great option. VA, again, isn't the bank. They allow you to put zero down, but you still have closing costs. So you're still going to pay closing costs at 1.5 to 2% of the purchase price, but the VA loan is great. The thing with the VA loan that's a little bit different is if me and Mary are married, we can be on the loan together and get that VA loan, no problem. But if I tried to get a VA loan with my sister Rita, we can't get 100% financing utilizing the VA loan because we're not married and she's a non-veteran. So you have to be married to do 100% financing. If you're not married, then you have to put 12.5% down to do a VA loan. So in that case, if it's, hey, my dad was a veteran and I wanted him to be on the loan, we're probably better off doing an FHA loan with 3.5% down, because the VA would require 12.5% down. Sorry, yes, 12.5% down. So I've had engaged couples that go and get, like, I've had a lot of couples that, like, we're not married yet. You can't be on the loan. You have to put 12.5% down. You can't do 100% financing. I've had a lot of couples go out and get married. Lots of trips to the courthouse over the last 14 years. So once you go to the courthouse, you can get 100% financing. You just can't tell your family. So that's really good.
Carlos says, is it wise to use money from your 401 or your Roth or traditional IRA to purchase investment property? And how do we find out the interest rate?
So I'm not a financial planner, but I will tell you 99.9% of the time, you're better off using that 401k money than letting it sit there, right? Because if that 401k money, just to use some basic math here, Carlos, if let's say you had 50 grand that you're going to pull out in that 401k, and let's say that 401k were to go up, that 50 grand was to increase 4% a year. It would go up $2,000 a year, that 401k, right? So sitting in that Fidelity account, it would go from 50,000 to 52,000 to 54,000 to 56,000. So in 3 years, your 50,000 would go to 56. If you use that same 50,000 and bought a $600,000 house, I'm just going to do basic math because if that house goes up 4% a year, let's say 12%, you've made $72,000. So would you rather make 72 or 6? I'd rather make 72. If you didn't follow that, I can do it again. But basically your 50,000 would turn into 56 because all that's growing is the money in the 401k. Versus when you invested in the house, what really grows is the equity in the property. The 600,000 is what's growing, not 50. That's where you see that big shift. So I think you're better off pulling it from the 401k. How do you find out interest rates? Typically, when we run your scenario, we'll run different pricing options. I always tell people that they can look on, like if you wanted to just see the national average. Let me see, Teresa, can you see my web?
Yes.
So if you just Google Freddie Mac rates, it shows you the annual mortgage survey. And so this shows you what the mortgage rates have done, shows you a historical look, gives you a weekly survey. So you can see last week, the average was 3.92. This is with 20% down and with almost 1 point cost in rate. So the rates are going to hit 4 here probably this week. You'll see this report come out on Tuesday.
Wow.
But this is a good way to track it where you can just see what the trend is doing, right? It was a weird run when we had the pandemic because it just dropped, right? Where's pandemic? Pandemic's like right in here, right? Pandemic starts in 2020 and then whoop, drops. But that's a good way to track it if you just want the general numbers, Carlos.
Wow. Michelle says, back to the VA loan. What if your spouse would have qualified for VA, but is recently deceased? Would it be possible to qualify as a surviving spouse, or would you have to just go with the FHA? And then Carlos' question is similar. What about the wife of a deceased serviceman? Can she use her husband's GI Bill for funding?
So I don't know if you can use the GI Bill. Typically, you can't use GI Bill as income, right? So if serviceman is in school and they're getting money from the state, can't use that as income. But if you're the surviving spouse of a veteran, you can use the VA benefits. Just depends on, there's a bunch of hoops. Yeah, there's a bunch of information that you have to get with the VA. Yes, you can use it as long as VA approves it. So surviving spouse is eligible to utilize that VA benefit. That's the short answer. The longer answer is call me, and we'd have to call the VA and kind of find out, get some information about the death and some other stuff that they require.
Sasha says, which is easier to qualify for, conventional or FHA? Does age matter, like 55 plus?
I don't know if there's either is easier. I think FHA probably is easier because they have more relaxed guidelines in most cases. So that's what I would say. I would say FHA is probably a little bit easier to qualify. Conventional, if you have better credit, it's usually a little bit easier. So probably FHA is a little bit easier to qualify for. Good questions. We'll talk a little bit about down payment assistance programs. So there's programs out here that can help you with down payment and or closing costs. And the main one is really Cal HFA is a program that works. Here's some pros and cons, right? Pros is obviously less cash out of pocket, allows you to get into the home faster, better than rent, better to own than rent. You can get, I'm going to go over the breakdown on the closing costs and how it actually works. Some of the cons are that the rates are higher. They're not 375% higher. That's a typo. It should be 0.375 because 375% would be a lot of interest. Usually the guidelines are more restrictive. So I always like to say the state gives with one hand, they take with the other. There's some limitations with regards to property values and limits and stuff like that. Typically, you're going to qualify for less in purchase price. So if you qualify for $600 on a regular FHA loan, you're going to qualify for about $550 using a down payment assistance program. The big one that we're seeing right now is the longer close times, right? So a lot of our closings are 10, 15, 20-day closes. with these down payment assistance programs, you're typically at least 45 days. And so in a market where, like Theresa mentioned, there's 8, 10, 12, 15 offers, a lot of times the sellers are less likely to accept the down payment assistance program, which needs more time to close than some of the other offers that may be stronger. So that's one of the things.
Sellers don't like that. They will skip over your offer.
In this market, it's very competitive. And so if you think about it, if you were a seller and you have LaRonda's putting 10% down, Joe's putting 5% down, and Theresa's putting 1% down, well, who looks like lower risk, right? So that's just something to keep in mind, because it is a challenge out there in this particular market. But you can use this Cal HFA program. You just have to be a first-time home buyer, which means you have not owned a home in 3 years. So if you owned a home 10 years ago, 4 years ago, 20 years ago, you would be considered a first-time home buyer. It's got to be a primary residence. You have to do a home buyer education class. There are limits as far as a minimum FICO score. So I think we talked earlier, I think Sasha may have asked the question about FICO score. So if you remember, 580 was the minimum on FHA, 620 was the minimum on conventional. Well, Cal HFA says you got to be at 660. There's different income limits. You can combine this program with other programs, which I'm going to show you as far as different assistance. You can do it conventional and FHA, and sales prices should be higher. I can't believe I didn't update that slide. You can't use a non-occupying co-borrower. So I can't be co-signing for Tracy and not living in the house. Everybody who's on the loan on a Cal HFA has to live in the property. Yes, you have to be a first-time home buyer. Yes, you can get FHA and DPA. Yes, you can get the down payment assistance program with the FHA loan. And you do have to be a first-time home buyer. That's the catch. So if you co-signed for your brother and you're just on his mortgage because you want to help him out, you're not a first-time home buyer. Even if you don't live there, even if you've never lived there, even if he lives in Kentucky, it doesn't matter. If your name is on the deed of a house, you're not a first-time home buyer. If your mom put you on her house because she's worried or just wanted you on title, you're not a first-time home buyer. Cannot be on another home. If you have ownership interest, no deal. Same if it was inherited. Sasha, if you own a home, if you have ownership interest in a house, you're not a first-time home buyer. Good question. So a lot of these programs have income limits. Here in California, they're really high. So here it shows you what the income limits. So household income in Orange County could be $211,000, LA 158, Riverside and San Bernardino 153, San Diego 188. So the household income can't be more than that. So if you're making 200 grand in LA County, you're not going to be eligible for this particular program. But you could make 200 grand and be eligible in Orange County. Different loan limits for different income limits for different counties. I should have made these green, and I apologize. Each county has different loan limits.
Say that again.
Each county has different loan limits. So the national loan limit for conventional loans, FHA loans, is $647,000. That's whether you're in California or Kentucky or Florida or Tennessee, right? 647, everybody can do 647. Wyoming, Pittsburgh, New York City, that's the conforming loan limit. Some areas have what's called a high balance limit. And high balance limits are typically in areas that have higher priced homes. So you can see Orange County, the loan limit in Orange and LA is $970,000. So you can literally buy a $970,000 house with 3.5% down. Actually, you could be close to $1 million house as long as your loan amount isn't more than $970,000. But where it gets tricky is when you go to Riverside and San Bernardino. because you could look at a, let's just use $650,000 house, right? $650,000 house in LA and Orange County is eligible. But when you go into Riverside and San Bernardino, now it's not, because you've exceeded their lending threshold. So you got to be careful, because when you look at that house here, and then all of a sudden you go to Lake Elsinore or you go to Corona, and you're like, man, look at these houses. Sometimes they may not be eligible for financing. You would have to put a lot more money down to bridge that gap.
Exactly. Rita wants to know about the, can you own a home in a different state and still be a first-time buyer in California?
Nope.
That was easy.
Nope.
Armida says for FHA, I understand it's 3.5%. So for example, in your 600K with 21 down, average mortgage of 3, can you put down more? Do you have to only put 3.5% down? Can you put down more?
No, more is better.
More is better.
We like more. I always say you could always pay more. You can't ever pay less. But yeah, if you put more money down, then that would bring the payment down. So that, yes, you can do that. Also, I got a question. If a co-signer has a good credit score, but low monthly income, if that would be good or bad. And so that's a little bit of a trick question, because if the co-signer has good monthly income or good credit, right? So let me come find me a new co-signer. Catherine's going to co-sign for me. I love doing this on Zoom, by the way, because I pick different people. I don't know who anybody is. I'm like, Brian, you're my co-signer. So Brian's my co-signer. Catherine got fired. Brian's my co-signer, and he's going to co-sign for me. He's got great credit, but he's currently unemployed. Sorry, Brian. That wouldn't be good, because he's going to have no income, and I'm still going to count his debt. Like in the other situation that we talked about, is his credit is good, but the debt, if he has debt, is going to count against qualifying. So that's the bad part about it. Now, if Brian had good credit and no debt, right, and no job, then you're fine. But again, let's compare. If Brian had an 800 credit score and Joe Soto has a 600 credit score, the 600 credit score is still the qualifying score. His 800 doesn't help me, doesn't give me a better credit score. I still have to fix my own credit.
That's a good point. I had a seller wanted to sell, and we told him he needed a co-signer to buy. And he went and found somebody that had good credit, no job, and got mad because we couldn't work with him.
Oh, yeah, because it doesn't help you, right? Like on the whole equation on how we calculate it all, it winds up hurting you more than helping you. The ideal co-signer, this is a good one if you want to start prospecting friends and family. Ideal co-signer is somebody with good credit, stable job or income, that isn't self-employed, doesn't own a home so that they don't have a lot of debt, and they don't have a lot of credit card debt. Preferably single, because if they're married, then their spouse is going to, give them a hard time about co-signing. So those are the 5 things. I should do a video on that. Should make that a five signs to know you're a good co-signer. Boom, 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 boom. That's
how my friend got me all those years ago. I met all of that criteria back then.
Yep. There you go.
Rita says she owns a home in her name only in Colorado. If my hubby and I buy a house out here, would he be able for the FHA program, or would it be better if it was under his name only?
So you can do so. It might be so. You only have to be a first-time home buyer to use this down payment assistance program. You could own a home or have owned a home to do an FHA loan. So FHA loan doesn't have that requirement. You could own a home right now. You could own 3 homes. Doesn't matter. You can still do FHA and do that. If you wanted to do a down payment assistance program in that situation, Rita, then yes, he would have to buy by himself. But you don't have to be a first-time home buyer for just FHA. You could have owned homes in the past. Cool. So here's just a little breakdown on how this CalHFA program works, right? It's on a 600 purchase price. Typically, you're going to put 21,000 down, right? 3.5% down. Closing costs on the CalHFA program, you'll see that they're higher than what Joe Soto told you 5 minutes ago. The closing costs were 1.5% to 2%. You can see the closing costs are higher when you do this program. If we were doing a regular FHA loan, the closing costs are about 12 grand, right?
Mhm.
So you'd have total costs of about 46 grand. That's this plus this. When you do the CalHFA, you get 2 additional loans. So you get a My Home program, which would give you $21,000.
Mhm.
You would get a ZIP program, which gives you $18,000.
Mhm.
So you basically, your total closing costs, I'll do it this way. So the total closing costs are 46. You're going to get the CalHFA second for 21. You're going to get the ZIP for 18. Leaves you 7 grand. 7 grand is what you would be having to come up with on your own. So that's that's a big difference between 21 plus 12, right? Between 36. So that's how this program would particularly work, right? So has higher costs because, again, give with one hand, take with the other. Some other restrictions, but as far as like overall cash, it's less money out of pocket. Now, these 2 loans, so this 21 and this 18, does have to be repaid. It is not free money. If it sounds too good to be true, it usually is. So if you were to sell the house in the future or try to refinance it, you would have to pay back this $39,000. So just keep that in mind too, because a lot of people think, oh, it's free money. Definitely not free money. They're going to come get their money at some point. So again, the benefit would be that you're getting this $39,000 up front instead of waiting to save the $39,000, right? Because who knows what happens to property values and interest rates over that time. Any questions on this?
Is that money forgiven if you're in the home for a period of time?
Negative. Nope. And what happens is people, no, it's not. You have to pay it. And a lot of times people forget about it. Like I've been talking to a lot of people over the last year or so that they did this. They were told by their lender at the time that it didn't have to be repaid. And it's a lien on title, right? Like, yeah, it does have to be repaid.
What happens if they sell the property in the first 3 years?
Doesn't matter. Sell it. Take your money and run. Go move to Puerto Rico. Wherever you want to go. There's no limitations. Sorry, I'm Puerto Rican. That's why I used Puerto Rico.
Is that 39,000, Joe, like a separate payment than the mortgage payment, or is it incorporated in, the monthly mortgage payment?
Who asked that question?
Mary,
that's the best question because I don't have it on my slide. So it is not paid at all. You pay 0 until you sell the house or refinance it.
Mm-hmm.
Great question, Mary. I gotta adjust my slide.
Very good question, Mary.
thank you.
You got me, Mary. Dang it.
Also, too, if you were to refi, you have to pay that up front before you're able to pull out any additional funds, correct?
Correct. So if you do refinance the mortgage, you do have to pay that back. And so that's something that people are seeing, right? Because let's say originally you did a loan for 600, right? And now you owe this 39, your new loan is going to be $639,000 plus closing costs.
So would it be beneficial after a period of time of being in the home to just kind of, once you have the money, it would be kind of wise to pay it back and then you don't have to worry about that?
You could.
Would that be wise?
You could. I would say I've never had anybody do it that way. Like everybody just sits on it and they're like, let me live my life. And then if I sell it, I'm going to pay it back. But yes, I mean, obviously paying off the debt is better than keeping it. 100%, Loranda.
I'm sorry, what was Mary's initial $100,000 question that she asked? That was so great, I missed it.
Her so far, if we were doing a giveaway, Mary would win because she busted Joe on his not having details on the slide. But basically she asked, if you have this 21 and this 18, right? And these have to be repaid when you sell the house, are there payments due while you own the house? And the answer is no, right? Like you're basically doing these two loans and they're silent second mortgages. You only pay them when you sell the house. You're not making payments on them. So there's not additional payments.
Okay, got it.
Good question.
Good to know. Thank you.
Yeah. I learned something new. I learned that my slide is missing something. Good question. Cool. That was a good one, Mary. Okay. So next we're going to talk real quick about pre-approvals. And again, I apologize for going over on time, but you guys have been great with questions and stuff like that. So I'm super grateful that I didn't have to sit here and stare at my screen and talk.
You haven't lost anybody. Everyone's still attentive. Uh-oh. You're frozen. There you go.
I'm frozen?
You were for a second. Now you're good.
Okay, so the difference of pre-approval is different than a pre-qualification in that a pre-qual, so there's different levels of approvals, right? There's a pre-qualification, which is basically lender just gets your information.
Uh-oh. Come back.
Pre-approval is where the lender gets your loan application, runs your credit, gets your W-2s, pay stubs, tax returns, all of your income documents, runs an automated underwriting approval, and confirms your purchase price, your pre-approval, your cash to close, monthly payment, all of that, right? So it's been reviewed by the loan officer. Beyond that, you can get what's called a conditional loan approval, which is something that we do. And I don't know if I have a slide in there. Nope. Nope. So then there's a conditional loan approval, which is where we actually have the underwriter review the loan to get you an underwritten approval, which we can do as well. Ultimately, like when we talked earlier about doing like a 15-day close guarantee, like in order to do something like that, you have to be very proactive and you have to have all of your ducks in a row up front. Otherwise, you'll never close on time, ever, ever, ever. So having either a pre-approval or a conditional loan approval will help you validate your offer, right? In a situation where there's multiple offers and I'm making an offer on a property, but Mago makes an offer on the property, Taylor does, Juanita does as well. And I'm the only one who's saying, hey, I can close in 15 days, same as cash. We're going to close quick. We're going to lower our contingencies. We're going to execute at a really high level. I'm pre-approved. I'm conditionally underwritten, right? Like my offer with all of that means more than Mary's pre-qual that says, yeah, somebody told me I qualify for 800,000. And in this market, you just have to have your ducks in a row, right? You have to be motivated. You have to show that you're the seller, you're ready to go. I always say speed kills, right? Shortening your contingency periods, being able to close. I mean, that's how we're getting all of our offers accepted in this market. I literally 15-day close 17, 15, 17, 20, 15, 17, 20. It's just crazy chaos in Joe Soto's life in this office. You can't see all the craziness in this office, but every day is crazy. Because at the end of the day, I think the most important thing, and I'll leave you with this, is that as a buyer, you have to understand the seller's mindset. And you have to understand that the seller wants to sell their home. They want assurances that their home is going to sell, obviously for profit, but they don't want you to back out, right? They don't want you to open escrow. They want you to close escrow. So putting that pre-approval together and having a strong team is super important to convey that to the seller. So that's really, really good. I'm looking at questions.
Michelle says, would the CalHalfa delay closing like the DPA programs?
Yeah, so the CalHalfa is a DPA program. That's a down payment assistance program. And that's the one that takes about 45 days to close. Because there's just more paperwork, right? There's 3 sets of loans, right? 3 things that have to be paid back, goes through a more extensive underwriting, and then actually has to go to CalHFA for approval. And that just takes a little bit more time. So, 30 days on that is tough to do. I think you're closer to 45, and I'm really, really good. Like, I feel like my team executes really well. Most lenders do not close in 15 days. I think we do it really well, but on those down payment assistance program, there's just more moving parts. It's like 3 loans in one. Credit question about paying off all credit cards before you do a hard check. Yeah, so I think that's a good question, right? Similar to the question that you had earlier, Teresa, as far as should you pay off all your debt and then have your credit run, or should you wait? Should you have your credit run and then pay off certain debt strategically? I personally think that you should have the credit run and then have the lender tell you, hey, pay off this, and this is going to get you the most bang for your buck, because you don't want to pay off Best Buy if you should have paid off Apple, or you don't want to pay off Visa if you should have paid off Discover, right? So exactly. I think doing that. Now, if you were going to pay everything to zero, maybe that's a different story, right? But if you weren't, I think you're better off having it, having somebody tell you what to pay, right? And yes, keeping those balances under 50%. Cool. Awesome. So congratulations. We got to the end. I appreciate everybody. I do a little survey. I'll take more questions if you have them. We do a little survey at the end. I'll let you scan the QR code. Typically, anybody who does the survey or does an application with us, we'll give them a $500 credit towards closing costs. So I'll give you the little survey. It's coming up on there. Also, we've got a class coming up. So if you follow me on social, you'll get the invite to the class, but it's just on credit. So whether it's for you or your kids or a family member or brother, sister, aunt, uncle, even if you're not looking to buy a house, learning about credit, March 16th, it's 10 a.m. It's on Zoom. We'll give you the link. It's on all my social that you can join us for that. And then here's the QR code. If you want to do the survey to get your credit on closing costs, you can do it on there. If you just scan the little thing, I don't really know how it works. Somebody told me. I told you I'm bad at technology, but it looks like I'm really good, right, Teresa?
You are the bomb.
Hey, the slide. Listen, don't let the slide fool you. I have these ideas, and then I have a great team that helps me execute it. But there's a survey there. If you complete the survey, that should be on there.
Scan the code.
Then,
take a picture of it.
Then you'll get the discount if we pre-approve you and we help you buy a house, which we've done a number of times and given the credit out. So it's super duper awesome. Follow me on social, all of that fun stuff. There you go. Trying to be 2022 right here, Teresa.
You are awesome.
I don't know how to put this in the chat. Otherwise, I would.
They can take a picture of it. They can do a screen capture.
Yes.
All of those things. We have closed a lot of people who have attended the home buyers seminar. So with that being said, I'm going to stop this recording.